Okay, let's unpack this because the financial reality of Wednesday, October 1st, 2025, it reads like a chapter from an inverted economics textbook. Seriously.
Right. It's quite something.
You had this massive, tangible political failure. I mean, the U.S. government officially began its 15th shutdown since 1981.
An event everyone sees as bad for confidence, obviously.
Exactly. And then, simultaneously, we got surprisingly weak, maybe even alarming, employment data signaling a real economic slowdown.
Uh-huh. Clear deceleration.
Yet, by the closing bell, the S&P 500 and the Dow Jones Industrial Average both closed at brand new all-time record highs.
It is the ultimate market paradox, yeah. And that's precisely why this deep dive is, well, crucial for you listening. We're not just going to summarize headlines here.
No.
We need to deconstruct the core operating thesis of the markets right now.
Yeah.
The question is, how did this pile of bad news instantly morph into a good news rally, and one strong enough to shatter records?
Exactly. My mission today is to cut through the noise, really show you the precise mechanism by which that market narrative just flipped. We're talking specific numbers, the reaction in the bond market, and that, corresponding tactical shift in equity allocations that drove these indices sky high.
And my mission is to frame this whole movement. We're looking at a calculated, almost aggressive bet on the Federal Reserve stepping in.
Right, the Fed put idea.
Exactly. We need to explore the engine of this rally, which, let's be clear, was the bond market repricing policy expectations. But critically, we also have to shine a spotlight on the incredibly contradictory signals flashing.
Like what?
Well, the surge in the VIX, the fear gauge, right? And new highs in gold. That tells us this foundation, even though it's record-breaking, is actually kind of fragile. It seems built on profound anxiety underneath it all.
And crucially, we have to talk about what's next, the immediate future, this impending information vacuum. The government shutdown has created a very real risk of delaying that critical official economic data, which means
the Fed and the market are about to try flying blind, right in maybe the most critical policy point of the entire year.
Okay, let's set the scene first. The psychological starting line. The mood around the market open was definitely risk-off.
Which made sense, right? It was the logical response to Washington grinding to a halt.
Totally. The government officially shut down at midnight. Futures contracts across the board, Dow, S&P 500, NASDAQ 100, they were all pointing significantly lower.
Yeah, Dow futures, for example, they were down, it's about 0.47%.
Right, which translates to like an expected loss of around 221 points. So apprehension was definitely in the air.
That initial fear was rational. Investors were trying to calculate the cost of this political dysfunction, bracing for uncertainty.
But then the market reaction it demonstrated a total rejection of that traditional political risk narrative.
Completely. By the close of regular trading, the S&P 500 finished at 6,711.20. That's a gain of 0.34%. Defiant. And officially an all-time closing record.
And the Dow Jones Industrial Average wasn't far behind either. It finished up 0.09% at 46,441.10, also grabbing an all-time high.
But the real tell, the true signal, as it often is, came from tech.
Yeah, the NASDAQ Composite led the whole charge. It closed at 22,755.1 cents, up 0.42%.
So this wasn't just a modest rebound. It was rapid, confident, and totally contradictory to the morning setup.
So what's essential here is understanding the narrative that allowed this defiance. What's driving it?
Well, the market's current operating principle, its main playbook right now, is what we call the bad news is good news thesis.
Okay.
This rally was fundamentally not driven by any belief that Washington would suddenly sort itself out.
Right. Not about political resolution.
Nor was it about any renewed optimism about underlying economic strength. Forget that.
So we have to explain the actual mechanism behind this paradoxical thinking. Why would a cooling economy, this visible deceleration, suddenly be seen as a bullish signal for stocks?
It's all about the perceived reaction function of the Federal Reserve. That's the key.
Okay.
The market has completely shifted its focus. It interprets any visibly decelerating economic data, especially weakness in the labor market, as a near guarantee.
A guarantee of what?
That the Fed will be compelled to implement monetary easing, specifically rate cuts.
Ah, so they think rate cuts are coming sooner.
Sooner and maybe even deeper than previously priced in, all explicitly to bolster growth and, try to avoid a recession.
So investors are basically operating under the assumption of that Fed put, the idea that the central bank will always step in to cushion the economy, backstopping the market whenever things look really weak.
Precisely. In this specific, highly technical scenario we saw play out, a cooling economy is actually fantastic for equity valuations.
How so?
Because it removes the threat of the Fed continuing to tighten monetary policy. It forces their hand towards accommodation.
So the entire rally is just a bet on the Fed's predictable response to bad data.
Exactly. It's not about the underlying data itself being good. It's about the consequences of that bad data for Fed policy. So we need to pinpoint the exact moment, the specific piece of data that caused this dramatic flip in sentiment.
And that moment, the definitive catalyst that just recalibrated policy expectations across everything, really, it arrived at 8:15 a.m. Eastern Time.
Yep. The release of the ADP Research Institute's private payrolls report for September.
Just one piece of labor market data, but it acted like a shockwave.
And the shocker wasn't just the headline number itself. It was the depth of the miss, combined with a, well, catastrophic revision to the previous month's data.
Okay, break that down. What were economists expecting?
They were bracing for a modest gain, maybe 50,000 private sector jobs added in September.
Okay, 50,000 gain expected. And the reality...
A net loss of 32,000 private sector jobs.
Wow. That's an enormous swing. From plus 50K expectation to minus 32K reality.
Huge swing. But wait, there's more.
Okay, let me stop you there, because the revision to the August data, I think that might be the single most destabilizing fact from that whole morning.
I agree completely. That's the kicker.
Okay.
August had initially been reported as a moderate gain of 54,000 jobs.
Right. Seems soft, but still positive.
Well, that seemingly okay data point was revised downward, sharply, to an outright net loss of 3,000 jobs for August.
Okay, that's not just a slowdown. That is a data shockwave. It means the labor market didn't just unexpectedly hit the brakes in September.
Right. It means we found out the cooling trend actually started a month earlier.
And was fundamentally misreported at the time.
Precisely. The negative signal gets amplified exponentially because it suggests the deceleration is deeper, more structural than anyone, maybe even including the Fed, previously realized.
And this realization, this sudden shock, it just rapidly convinced the market that the Fed's timeline for rate cuts had been dramatically pulled forward.
Instantly. And the verdict on that realization, where it showed up first, not in stock futures initially.
Where then?
In the Treasury market. This is critical for you, the listener, to grasp. The bond market is always the first, the most sensitive indicator to reprice monetary policy expectations.
And the reaction in the quote-unquote risk-free rate was immediate and sharp, confirming that shift in thinking.
Absolutely. The yield on the benchmark 10-year Treasury note, it sank swiftly. It went from around 4.16% lead the previous day down to as low as 4.10%.
Okay, 4.16 down to 4.10. That's a 0.06 drop in basis points.
Right. Now, that might sound minor to a casual observer, but in percentage terms, it's a 1.44% decline in the yield itself.
And that reflects?
It reflects a rapid, aggressive repricing of imminent monetary easing. When yields drop that sharply, it signals that market participants expect future interest rates to be lower.
Which makes existing bonds more valuable today.
Exactly. Higher bond prices, lower yields.
And this movement, these lower yields, that's the core connection, right? The primary fuel for the equity rally that followed.
That's it. The weaker the economic data, like that ADP report, the stronger the case for rate cuts.
Which pushes bond prices up, yields down.
Which in turn benefits stocks. It's a clear chain reaction.
Okay.
So this sharp drop in the Treasury yield, which is really the baseline interest rate for almost all financial calculations, it had two profound immediate consequences for stock valuations.
Especially for certain types of stocks.
Particularly benefiting the growth and technology sectors, the ones that really drove that NASDAQ rally.
Okay, let's break down those two consequences clearly for the listener. The first one is the direct benefit to corporate finances.
Right. Lower Treasury yields generally translate pretty directly to lower borrowing costs across the economy. Corporate loans, credit lines, they're often benchmarked against these risk-free rates.
So if companies can borrow more cheaply,
their interest expenses go down, which directly improves their future profitability and their cash flow. That part's just simple arithmetic.
Okay, that part seems intuitive. Cheaper money means higher potential profits down the line. But the second consequence, the valuation effect, that's a bit more abstract, isn't it, requires a deeper dive into finance.
It is, but it's arguably the most powerful driver of this particular rally we saw. We value a company's stock based on the present value of its expected future earnings.
Right. Money in the future is worth less than money today.
Exactly. And the further out those earnings are expected, the less valuable they seem today. The tool we use to convert those future dollars into present dollars is the discount rate.
And the benchmark for that discount rate is often
the risk-free rate, the Treasury yield.
So help me connect the dots. If The 10-year Treasury yield falls from 4.16% to 4.10%, even though it seems like a small move. How does that mathematically boost the value of, say, a tech stock whose big profits might be 5 or 10 years away?
It has an enormous multiplier effect, especially for what we call long-duration assets. Think early-stage AI firms, biotech companies, high-growth tech firms whose peak earnings are far in the future.
Okay.
If you lower the discount rate used in your valuation model, you are mathematically assigning a higher present value to those profits expected way out in the future. A small change in the near-term rate assumption can lead to a leveraged, sometimes dramatic increase in the theoretical fair value of those growth stocks today.
Okay. So those companies, the ones maybe not generating huge profits right now, but promising massive earnings in, say, 2030 or beyond, they suddenly look disproportionately more attractive today.
Precisely.
Just because the cost of money, the discount rate, is expected to fall dramatically over that long time horizon.
You got it. That is exactly why the NASDAQ composite led the market higher. The tech stocks benefited most from that lower discount rate.
And the conviction in this whole thesis, this bet on lower rates, it was solidified pretty quickly.
Oh, yeah. Look at the derivatives market. The CME FedWatch tool, which calculates probabilities based on trading in Fed funds futures contracts.
What did it show?
It indicated pretty much right away a nearly 95% probability of a Fed rate cut at its very next meeting.
95%. Wow.
So the market wasn't trading on hope. It was trading aggressively on what it saw as a near certainty of central bank accommodation.
But wait a minute, isn't that complete reliance on the Fed being predictable inherently dangerous? If the market is 95% certain of a rate cut, what happens to stability if Powell and the Fed decide to throw a curveball? Or what if the economic data itself proves to be just wildly volatile, like that drastic ADP revision we just talked about, and the central bank kind of loses credibility in its own forecasts? That certainty feels incredibly fragile to me.
That is absolutely the right question to be asking right now. The market has priced in the rescue.
Yeah.
If that rescue fails to materialize for whatever reason, or if the underlying economic slowdown actually deepens into something worse, like a crash,
Then what?
then the market's foundation, which is built almost entirely on this policy assumption, it will crack severely. And that brings us directly to Section 3. The profound contradictions bubbling beneath the surface, the signals that prove investors are, in fact, incredibly nervous, even while hitting record highs.
Right. So if the market truly deeply believed in this Fed-backed rosy future, you'd expect to see a widespread, maybe even euphoric risk-on environment across the board.
Makes sense. Broad participation. But this is where the picture gets really interesting, because beneath that record-high S&P 500 number, we saw clear quantitative signals of deep-seated anxiety just bubbling up.
Okay, what's the primary indicator of that anxiety?
It's the VIX divergence. Let's focus on the VIX, the SIBO Volatility Index. Everyone knows it as the market's fear gauge, right?
It measures expected volatility using S&P 500 options.
And typically, the VIX has a strong inverse correlation with the S&P 500. When the S&P rallies strongly, confidence is usually high and the VIX falls.
But that's not what happened on Wednesday.
Not at all. On this record-setting day, the S&P 500 rallied, yet the VIX rose 2.46% to close at 16.68.
Up 2.46%. Okay, that's a textbook divergence. It signals hedging activity, right?
Absolutely. What does that rise in the VIX actually imply about investor behavior? It sounds like they're betting aggressively on the upside with one hand.
But simultaneously buying maximum insurance with the other hand.
That's a perfect analogy. It means that while money managers were buying stocks to capture this expected Fed-driven rally, they were also actively purchasing option contracts. Specifically, out of the money puts. They were hedging against a sharp, rapid downturn in the short term.
So they're participating, but cautiously.
Very cautiously, and highly leveraged against specific near-term risks. Maybe the failure of the shutdown negotiations, or perhaps a really negative surprise from the upcoming non-farm payrolls report, if it even comes out.
So it shows a lack of broad-based fundamental conviction instability then.
Exactly. It's a specific bet, not a general feeling of confidence.
And that caution was also, well, screaming from the safe haven assets, wasn't it?
Oh, definitely. We saw a clear flight to safety, which directly contradicts the aggressive risk-on behavior we just saw in tech stocks.
Look at gold.
Yep. Gold futures climbed to new all-time highs, broke decisively above $3,900 per ounce, That was a daily gain of about $45, or roughly 1.2%.
And gold is the classic asset people flock to
When they fear political instability, like we have with the shutdown, or when they fear economic weakness, which was just confirmed by that ADP report.
So the fact that capital was rushing into physical safety assets like gold, while at the same time bidding up high-risk equities.
It just underlines this severe internal conflicts gripping the market right now. The message is completely fractured.
So, okay, the equity market is screaming, the Fed will deliver rate cuts, so buy growth stocks.
Right.
But the options market and the commodities market are whispering, maybe even shouting, hold on, the economy is decelerating sharply and Washington is a mess, so protect your capital.
Exactly. And we actually have hard data supporting that whisper, that cautionary tale, extending beyond just the ADP report.
What else came out?
The ISM manufacturing PMI for September, it provided more evidence of pretty deep economic malaise.
What was the number?
The index registered 49.0. Now remember, 50.0 is that crucial line separating economic contraction from expansion.
So 49.0 is contraction.
Yes, and it not only came in below the 49.2 consensus estimate, but it also marked the 7th consecutive month of contraction for the U.S. manufacturing sector.
Wow, 7 consecutive months. That's not just a temporary hiccup. That really suggests some structural strain in manufacturing.
It does. And if you dive into the details, the sub-indices within that ISM report, the weakness is particularly concentrated in new orders and employment.
Okay. New orders being soft suggests.
It suggests businesses are becoming highly cautious about future demand. They're not booking new projects as readily.
And the employment subindex.
It basically echoed the ADP report, signaling that manufacturers are indeed shedding workers.
The source material also points out that the sector is being hampered by tariffs and that lingering global uncertainty. So that confirms this isn't just a domestic slowdown, but it's also a consequence of those external geopolitical pressures weighing down on U.S. industry.
Exactly right. So basically, every macro data point released on October 1st, from the labor market weakness in ADP to the manufacturing sector contraction in ISM, it all suggested a significant economic deceleration.
And you mentioned construction spending, too.
Yeah, add to that the August construction spending data. It showed a decline of 0.1% month over month, which actually matched estimates but still showed moderation.
So the deceleration seems validated across multiple metrics.
It does, which makes those record-high stock indices look even more like an anomaly, driven purely by that policy expectation, not by any sign of fundamental economic health.
Okay, let's shift our focus now from those big macro contradictions down to the micro movements within the market. Where did the money actually flow across the different sectors?
Right. Sector performance is often the clearest indicator of where investors are placing their bets and which parts of the economy they're trying to avoid.
So, given the profound yield sensitivity we talked about earlier, with Treasury yields dropping?
It's entirely unsurprising that technology was the standout leader. That's what drove the NASDAQ composite so much higher.
Because when the discount rate falls,
the mathematical valuation boost for tech, especially AI-related investments, is just massive. These themes have pretty consistently dominated the gains throughout 2025 anyway, and this drop in Treasury yields just gave them another huge tailwind.
Okay, so tech-led, what else did well?
Healthcare was the other major leader.
Yeah.
That seemed driven by some positive policy developments specifically, maybe some favorable news regarding regulatory hurdles or pricing policies that were seen as beneficial to pharmaceutical companies, made their future cash flows look a bit more stable.
And conversely, which sectors lagged? The ones that depend on actual economic growth.
Exactly. Economically sensitive sectors like financials and materials, which really thrive when industrial activity and consumer spending are strong, they perform poorly.
Which just reinforces the core thesis, right?
Absolutely. It shows investors are deeply concerned about the pace of the real economy, even while they're betting heavily on the Fed's response to that weakness.
Now let's dive into some of the really dynamic individual company moves. Nike, a major Dow component, was a clear winner, up 6.4% after its earnings. What did that tell us?
Well, it told us a few things. First, they crushed their fiscal Q1 earnings expectations. They reported $0.49 EPS versus the $1.27 estimate, which is huge. And revenue was robust too, $11.72 billion against an $11.0 expectation.
Where did the strength come from?
largely driven by a strong 4% increase in North American revenue and continued success in their running business segment.
But if we're trying to read the tea leaves here, we have to look at the dichotomy within those results, right? Why was North America so robust, yet their revenue in Greater China actually declined by 9%?
That dichotomy speaks directly to shifting global consumer health and maybe some geopolitical risk management. The U.S. consumer, while definitely showing signs of strain overall, is apparently still spending on premium athletic wear, maybe helped by some residual savings or credit use. But the slowing economic growth and increased consumer caution in key international markets, particularly China, that immediately impacts these big multinational giants like Nike.
Did they give any warnings?
Yeah, Nike even flagged ongoing gross margin pressure that they expect to continue through fiscal 2026. So profitability remains a constant battle, even with that headline earnings beat.
Okay, let's talk about the day's biggest individual stock winner, Lithium Americas, ticker LAC. It surged an incredible 23.3%. This wasn't about quarterly profit, was it?
No, this is much more about deep-seated U.S. industrial policy, pure policy play.
What was the catalyst?
The catalyst was the news that the U.S. government agreed to allow LAC to draw from that previously announced massive $2.26 billion loan for its Thacker Pass lithium project in Nevada.
And crucially,
the Department of Energy is actually taking an ownership stake in the project as part of the deal.
okay, the implication there is enormous, isn't it? It signals a massive government commitment to securing the domestic supply chain for EV batteries.
Absolutely. This isn't just a standard loan. It's the government actively placing a strategic financial bet on resource sovereignty. National security implications.
So it underscores the urgency in Washington to onshore critical mineral production.
Especially given geopolitical tensions, yeah. It essentially de-risks the future of the American EV manufacturing sector, at least partially. It transforms LAC from just another mining play into potentially a strategic national asset.
And sticking with big money moves, the utility sector saw AES Corp climb nearly 17%. What was that about?
M&A chatter. Reports surfaced that a fund owned by BlackRock was nearing a deal to buy the utility firm. The potential price tag mentioned was around $38 billion.
So large-scale corporate interest remains strong despite the macro fears.
Yeah, that M&A movement suggests that large pools of private capital are looking past the immediate economic turbulence. They want to acquire essential infrastructure, like utilities with predictable cash flows, possibly at attractive prices right now.
Okay, turn to the downside. On the losing side, Corteva, the big agricultural company, sank 9.1%.
They announced plans to split into two independent public companies, one focusing on seeds, the other on crop protection chemicals.
And breakups cause uncertainty.
They do. While they're often designed to unlock long-term value by giving each new entity a clearer focus, they create significant headaches for institutional shareholders in the short term. People have to reevaluate, do they want to hold both new stocks? Which one fits their mandate? That uncertainty causes immediate selling pressure.
Got it. And Peloton Interactive dropped 3.7%. The report said they faced a cold reception to unveiling their new AI and computer vision system.
Yeah, that market skepticism is pretty telling. Peloton is trying, maybe needing, to execute a strategic pivot away from relying solely on those pandemic-era hardware sales.
But the market isn't buying it yet.
Apparently not. The market seems to be signaling that the path to restoring sustainable growth using this new AI tech is, well, deeply unconvincing so far. It shows investors aren't just buying hype. They demand clear evidence that these strategic pivots can actually translate into tangible sales and profitability.
Okay, finally, let's quickly touch on the really profound divergence we saw within the electric vehicle sector itself, particularly among the Chinese manufacturers reporting their September delivery figures.
Right, definite winners and losers there. XPeng and NIO posted incredibly strong, record-breaking numbers.
Give us the numbers.
XPeng delivered 41,581 vehicles. That's a massive 95% year-over-year increase. NIO also hit a record with 34,749 vehicles delivered, up 64.1% year-over-year.
So that suggests strong success for them.
Yeah, suggests their aggressive expansion strategies and maybe recent product updates are really paying off.
But then you had Li Auto, whose year-over-year deliveries actually dropped 36.8%.
Right. And the data proxy we often use for Tesla sales in China, which is insurance registrations, that showed an 8.7% year-over-year decline for Tesla in September.
So what does that mixed bag tell us about the Chinese EV market?
It illustrates a brutal, highly competitive battlefield. While overall EV adoption keeps climbing rapidly in China, the market itself is fragmenting. Pricing pressure is intense, competition is fierce, Brand loyalty seems thin. Success really depends heavily on having a constant stream of new, desirable models.
And some are clearly navigating that better than others right now.
Exactly. Lion Auto and Tesla, despite their scale, seem to be struggling to keep pace with the aggressive growth of some local competitors like XPeng and NIO in that specific dynamic market environment. Okay, we absolutely must pivot now to the central tension that's going to govern the next 48 hours and maybe even beyond. The government shutdown and this looming risk of an information vacuum.
Right. Because remember, the entire rally we've been dissecting, it's predicated on this idea that the economy is slowing down enough for the Fed to cut rates.
And that thesis must be confirmed or denied by official comprehensive government data.
But the shutdown threatens to completely disrupt the timely release of that official data, specifically the most influential, highest-stakes report of the month.
The September non-farm payrolls report, scheduled for this Friday, October 3rd.
What happens if that report gets delayed? Which seems like a real possibility.
If it's delayed, and yeah, the risk is substantial, the market, and just as importantly, the Federal Reserve itself, will be forced to rely entirely on less comprehensive private sector indicators, like that ADP report we just picked apart, or various confidence surveys.
And that increases volatility.
Exponentially. Because the Fed's policymakers, the people actually making the rate decisions, they're now potentially navigating a critical policy juncture without their most important, comprehensive, verifiable official data sets. They're flying blind.
That sounds like a direct threat to the Fed's policy credibility. If they have to make rate decisions based purely on speculation or incomplete private surveys.
They risk either overreacting to short-term noise or underreacting to true underlying economic distress. It's a terrible position for them.
So what key economic reports are we actually watching for in the immediate future, assuming they do come out?
Well, Thursday's data will be intensely scrutinized, especially after the shock of that ADP report. We need to watch the initial jobless claims report. Consensus is forecasting around 215,000 claims.
And if that number comes in significantly higher,
It would corroborate the rapid labor market weakness seen in the ADP data and really cement that dovish narrative, increasing rate cut expectations even further.
anything else on Thursday?
We also get factory orders for August. That gives us another piece of insight into the longer-term health of the manufacturing sector, which we know has been weak.
Okay, and then Friday, the potentially delayed reports that really hold the key to the market's current bet.
Correct. First, the big one, non-farm payrolls. Consensus currently projects a gain of 170,000 jobs, but honestly, forecasts are highly unstable after that huge ADP miss.
Right. What else on Friday?
The unemployment rate. Consensus is looking for 3.8%, which would be down from 4.3% previously. That seems optimistic now. And critically, average hourly earnings. That's arguably the single most important inflation indicator the Fed tracks within the labor market data.
So the market impact of these Friday reports, if they get released on time, it sounds almost binary. Very profound either way.
Completely binary. If the payrolls report comes out strong, let's say well above 200,000 jobs added, it immediately challenges this whole dovish narrative. It would suggest the economy is actually more resilient than ADP implied.
And the market reaction would be?
A rapid, probably violent sell-off in both stocks and bonds as those aggressive rate cut expectations are quickly pulled back.
Okay, and conversely, if the report comes out weak as ADP suggested.
Then it fully validates the current market positioning. It fuels further gains, confirming the Fed bet. But the risk of delay itself means this volatility could be hugely magnified just by speculative trading happening in the absence of the actual truth.
Uncertainty
Breeds volatility.
So in this climate of heightened uncertainty about the official data, do corporate earnings reports become even more important as real-time checks on the economy?
Absolutely. They become highly valuable real-time barometers of consumer health and business sentiment, which the Fed also tracks very closely.
Any key reports out recently or coming up?
Well, Levi Strauss was scheduled to report after the close on Wednesday. Their Q3 consensus EPS estimate was 0.30 cents. Their actual results, and importantly their forward guidance, will be crucial for understanding how inflation and slowing activity are impacting discretionary consumer purchases, especially for those middle to high income brackets.
And looking just a bit further ahead, we need to keep a very close eye on the earnings calendar for more consumer health clues, right?
Definitely. Specifically, watch for Constellation Brands, the drinks company, reporting on October 6th, and McCormick & Co., the spice maker, on October 7th.
Why those two?
These companies provide really good insight into consumer spending patterns on non-essential items like alcohol and also everyday items like packaged foods. They offer real-time data on how household budgets are being stretched by inflation and what choices consumers are prioritizing.
So these corporate reports essentially become essential pieces of the economic puzzle, especially when the official government data might be missing or delayed.
Exactly. They fill part of that potential information vacuum.
Yeah.
Hashtag tag outro. So let's try and synthesize the key takeaway here for you, our listener. The market's dramatic, record-breaking move on the very day the government shut down was not an expression of economic confidence. Not at all.
No, it was something else entirely.
It was a purely calculated, maybe even fragile bet on accommodative monetary policy. It was a conviction, rightly or wrongly, that overwhelming evidence of economic deceleration will simply force the Federal Reserve to cut interest rates, probably very soon.
But the underlying reality, as we've discussed, remains deeply troubling. You've got 7 straight months of ISM manufacturing contraction.
A shockingly weak labor market picture exposed by that ADP data and its revision.
And this persistent investor anxiety, clearly visible in gold hitting record highs and the VIX surging right alongside the S&P 500.
It's an incredibly unstable equilibrium. It seems built almost entirely on faith in the central bank's next move.
The market has priced in the rescue, as you said.
It has. But now it's facing this nearly unprecedented obstacle, a potential complete or partial information blackout, right during a critical decision-making period for the Fed.
So the policy response is now contingent not just on the economic data itself, but on whether the government is even operational enough to release that data on time.
Which is a bizarre situation.
Okay, here's where it gets really interesting, and this is the challenge, I think, for the Federal Reserve, but also for you listening going forward. In the absence of that comprehensive official data, like the non-farm payrolls report, policymakers are navigating this crucial juncture with potentially very incomplete information.
Big risks there.
So what are the broader risks to policy credibility, to future market stability, especially when key decisions might have to rely almost entirely on speculation or private surveys rather than those official comprehensive data sets? And maybe more importantly for you, what knowledge will you seek out, maybe in the form of these corporate reports we mentioned,
Sure.
or alternative economic indicators to try and fill that information vacuum yourself and protect your decisions this week? Because one thing seems certain.
What's that?
The market will not wait patiently for Washington to reopen its doors.